Warren Buffett, the Oracle of Omaha, the man with a $100 billion fortune, once missed a $100,000 investment that could have earned him over $1 billion. And the worst part, he saw the opportunity up close every single day. Imagine you were sitting on a gold mine, watching it sparkle. Everyone around you is using it, benefiting from it, but you walk away because you don't get it. Years later, that same opportunity becomes one of the greatest businesses of all time. That's exactly what happened when Warren Buffett passed on investing in Google. In this video, we'll unpack how Buffett missed Google, how he realized it, and most importantly, what you, the everyday investor, can learn from one of the smartest minds in financial history. Because if Warren Buffett can get it wrong, so can we. Stick with me till the end, because the third lesson alone could help you avoid $1 million mistake in your own portfolio. How could one of the smartest investors in history, Warren Buffett, miss out on one of the greatest companies of the 21st century? Why didn't he invest in Google, even when one of his own companies was using it to make millions in profit? Was it because he didn't understand the internet? Or was it something deeper like fear, overconfidence, or outdated principles? And more importantly, what can you learn from the $1 billion mistake Buffett admits he regrets to this day? Let's break down what really happened, and how even Buffett's failure can become your greatest investing lesson. Reason 1. He was too late to adapt to the digital economy. Buffett has long admitted that he avoids businesses he doesn't fully understand. That works when you are choosing railroads, or soda, or some other traditional business. But in the case of Google, this rule backfired. Warren Buffett once said, "The best investment you can make is in something you already understand." But when it came to Google, he didn't follow his own advice. And here's the twist. One of the companies he owned, Geico, was actively using Google Ads to grow its own customer base and make a ton of money. So Buffett wasn't just seeing Google from the outside. He had a front row seat to how powerful the business was, and still missed it. What did Buffett say later? "We blew it. We saw it through Geico. We just didn't figure out the business model." But by the time Buffett considered investing, Google had already gone public. The stock had skyrocketed. The value investing window had closed. Moral of the story is, sometimes, being too strict with your principles can cost you dearly when the world changes. Reason 2. He didn't understand Google's moat. Let's talk about the core reason Buffett missed this billion-dollar opportunity. He didn't understand how deep Google's moat really was. In Buffett's world, a moat means competitive advantage, something that protects a business from being attacked. Coca-Cola has brand loyalty. Apple has ecosystem lock-in. Geico has pricing and float. But Google, it had a free product, search, with no immediate revenue. A business model based on ad auctions. A moat built not on taste or pricing, but on data, algorithms, and user intent. For Buffett in 2004, this looked too abstract. He liked products you can touch and measure, not ones that lived in data centers. Ironically, Google's moat, its search engine dominance, became one of the widest and most durable in the history of capitalism. Fast forward to today, Google controls over 90% of global search. It earns $180 per year from search ads alone. Buffett missed what he later recognized as one of the greatest compounding machines ever built. Reason 3. He misjudged the new age of business models. Buffett has always preferred simple business models. Example 1. See's Candies. You buy a box of chocolates for $300. It costs them $150 to make. They make $150 profit. Repeat that across thousands of customers. Simple, yes. Predictable, definitely. Example 2. Geico, insurance. Geico is an insurance company Buffett bought because it was easy to model. You pay $10,000 a year for car insurance. Most people don't have accidents, so Geico keeps the money. Called float. They invest that float and grow their profits. Again, straightforward, low-tech, reliable cash flow. Buffett loves this kind of business. In his words, "I don't invest in businesses I can't explain to my grandchildren in one sentence." Then came Google, and Buffett froze. A free search engine, used by almost everyone, but monetized in a new way. So how did it make money? Through ads. But not normal ads. Through ad auctions. It was free to users, and made money from a second party, that is advertisers. This dual-sided model felt alien. Here's the trap. Google wasn't selling a product. It was selling attention. It was selling intent. Buffett didn't fully grasp how scalable and sticky that model was. But here's the kicker. The same misunderstanding made him miss Amazon and Microsoft too. Eventually, he adapted, starting with Apple. But Google, that ship had sailed. Reason 4. He underestimated the value of tech even after the dot-com bust. Buffett was deeply scarred by the dot-com bubble. While he avoided the crash, it made him overly cautious about anything tech-related for years. In fact, he didn't invest in Apple until 2016. He missed Amazon, even while admiring Jeff Bezos. And he missed Google, even though it was helping one of his own companies grow. His logic was that, I don't invest in businesses I don't understand. The problem here was that the world had changed. Software wasn't just a sector, it was dominating the world. Buffett later admitted that by the time he realized how dominant these companies were, the price he was willing to pay no longer made sense. Takeaways and lessons for investors. Warren Buffett is one of the greatest investors of all time. He built a $100 billion fortune by staying disciplined, patient, and rational. But even he missed Google. And that teaches us something powerful. You don't need to be perfect. You just need to learn fast and adapt. Here are 5 big takeaways from Buffett's Google miss, with real-world examples to drive the point home. 1. Don't ignore what you use every day. What Buffett did, he used Google. He saw it work for Geico. Still, he didn't invest, because he didn't take time to understand how it made money. Today, we all use apps and platforms daily. YouTube, Swiggy or Zomato, UPI apps like Phone, Amazon, Instagram. If you're spending time or money there, please ask, how does this company make money? Is it profitable? Does it have a moat? For example, if you used Netflix in 2010, you saw the shift from DVDs to streaming. $1,000 investment in Netflix back then, or today it is worth over 50 lakh plus. Key takeaway here is that you already have investing clues all around you, in your wallet, your phone, your habits. Don't overlook them. 2. Understand what a modern moat looks like. Buffett missed Google because he couldn't see its moat. Traditionally, a moat meant a brand like Coca-Cola or a huge-scale business like Walmart. But Google had a digital moat. Search data, user behavior, AI and machine learning. Billions of users creating a feedback loop. Think of WhatsApp. It's free, but hard to replace. Why? Everyone you know is already on it. That's network effect. A moat. Another example. Amazon knows what you buy, when you buy, how you buy. That's data advantage. Another moat. Modern moats are often invisible, built on data, user behavior, and scale. Learn to recognize them early. Third takeaway is, complexity isn't always bad. It might mean opportunity. Buffett didn't get the potential of Google's auction-based ad model. It sounded complicated compared to selling a candy bar. But guess what? That complexity was exactly what made Google unstoppable and incredibly hard to copy. AdSense and AdWords were generating revenue 24/7 from millions of advertisers, even while Google slept. Facebook ads also seemed complicated at first, but creators and brands that learned early now generate crores in revenue from it. Just because something seems complex doesn't mean it's a bad investment. Often, if you take the time to understand it, that complexity is where the edge is. Fourth takeaway. Don't let principles become shackles. Buffett had a powerful principle. I only invest in businesses I understand. It worked for decades. But when business models changed, he stuck to his old filters too long. The world evolved. He didn't, and that cost him. 2 other well-known examples of Buffett missing the tech stocks are Apple. Buffett didn't buy Apple until 2016. Amazon. He avoided Amazon for years, despite publicly admiring Jeff Bezos. Eventually, he adjusted, but slowly. A key learning here is that principles are good, but if you never update your filters, you'll keep saying no to tomorrow's winners. Ask yourself, are you ignoring great ideas because they don't fit your old mental models? Lesson 5. Missed opportunities are inevitable, but they're also educational. Buffett says it best, the mistakes you make by not investing are the ones that haunt you the most. Even the greatest investors miss big opportunities, but they don't cry over them. They study them, learn from them, improve their process. Buffett missed Google, Amazon, Microsoft, but used those lessons to recognize Apple's potential. His Apple investment, over $30 billion, has now earned Berkshire more than $100 billion in gains. Compare that to the Google miss. If he had learned earlier, Berkshire could have owned both Google and Apple and doubled its value. You will miss out. But what separates smart investors from the rest is this. They turn regrets into research. They turn FOMO into foresight. If Warren Buffett, the man who reads 500 pages a day, can miss a company he uses, then maybe investing isn't about being perfect. It is about being humble, curious, and adaptable. So the next time you see a product you love, don't just be a user, and ask, what if I was an owner? That mindset alone could change your financial future. The next time you feel like you've missed an opportunity, just remember, even Warren Buffett once missed a $100,000 investment. That could have become $1 billion. And what did he do? He studied his mistake. He learned from it. He adapted. If this video gave you a new perspective on investing, or helped you think differently, smash that like button, subscribe, and hit the bell icon so you never miss a moment of financial wisdom. Drop a comment below. What's one company you regret not investing in? Because this channel is all about learning, not just from the wins, but from the missed billion-dollar mistakes too. See you in the next video.